The ratio is collapsing. The most important indicator in the precious metals market, the one metric that has predicted every major silver bull run in modern history, is flashing a signal so powerful that it cannot be ignored. For years, we have watched the gold-silver ratio hover at absurdly elevated levels. We have seen it stretch to 80, 90, even 120 during the pandemic panic. We have listened to the mainstream analysts dismiss it as irrelevant, as an outdated relic of a bygone monetary era. We have been told that silver is just an industrial metal, that its historical relationship to gold no longer matters, that the ratio can stay elevated forever because the modern financial system has moved beyond such primitive measures of value. We were told to ignore the signal. We were told the old rules no longer apply. We were told that this time is different, but this time is never different. The fundamentals always win. The mathematics always prevail. And the gold-silver ratio always reverts to the mean. What we are witnessing right now is not a minor fluctuation. It is not a temporary blip caused by speculative froth. It is the beginning of a seismic compression that will reshape the precious metals landscape and transfer enormous wealth from those who ignored the signal to those who understood its meaning. Ladies and gentlemen, this is Silver Storm Daily, and today I'm going to show you why the crashing gold-silver ratio is the most important financial development of the year, and why it signals that silver is about to dramatically outperform every other asset class on the planet. Let me start with the numbers, because the numbers are staggering. At its peak during the March 2020 pandemic crash, the gold-silver ratio reached 123. That means it took 123 ounces of silver to buy 1 ounce of gold. This was the highest reading in recorded history, higher than the Great Depression, higher than the 2008 financial crisis, higher than any point in the 5,000-year history of these metals trading alongside each other. The ratio at 123 was a screaming buy signal for silver. It was the market telling you in the loudest possible terms that silver was the most undervalued it had ever been relative to gold. And what happened next? Silver exploded from $12 to nearly $30 in a matter of months. The ratio collapsed from 123 to 65. Those who listened to the signal made massive gains. Those who ignored it missed the opportunity of a decade. Now look at what is happening today. The ratio has been compressing again. It has fallen from the mid-80s to below 70. And the pace of compression is accelerating. In the last month alone, the ratio has dropped by more than 10 points. This is not normal price action. This is not random noise. This is the market sending the same signal it sent in 2020, and in 2011, and in 1979, and in every other period that preceded a massive silver bull market. The ratio is crashing because silver is about to leave gold in the dust. Now I need to explain what the gold-silver ratio actually is, and why it matters so much. The concept is simple. You take the price of gold and divide it by the price of silver. The result tells you how many ounces of silver it takes to buy 1 ounce of gold. A high ratio means silver is cheap relative to gold. A low ratio means silver is expensive relative to gold. Throughout most of human history, this ratio has averaged between 12 and 20. The ancient Egyptians set the ratio at 2.5 to 1. The Romans used a ratio of 12 to 1. The United States Coinage Act of 1792 established a legal ratio of 15 to 1. For thousands of years across dozens of civilizations, the ratio remained in a relatively tight band because both metals were recognized as money. They were the foundation of the monetary system. Their relative value was determined by their relative scarcity in the Earth's crust, which geologists estimate at approximately 8 to 1, and by their relative utility in commerce and industry. But something changed in the 20th century. The world moved away from a metallic monetary standard. Gold retained its status as a reserve asset held by central banks. Silver was demonetized. It was reclassified as merely an industrial commodity. And the ratio began to drift higher. By the 1990s, it had reached 60. By the 2000s, it was hovering around 50 to 70. By 2020, it had exploded to over 100. This expansion of the ratio was not natural. It was not the result of free market forces. It was the result of a deliberate campaign by the banking system to suppress the monetary status of silver and keep its price artificially low. Think about why the banks would want to suppress silver. Silver has always been the money of the common people. Gold was for kings and central banks. Silver was for merchants and workers. An ounce of silver was a day's wage for a Roman soldier. A silver dime in America could buy a loaf of bread. Silver circulated in the hands of the masses. It was tangible, divisible, recognizable, and trusted. This made silver dangerous to the fiat currency system. If people could easily transact in silver, they would have an alternative to bank-issued paper. They would have a way to store value outside the system. They would have freedom. The banks could not allow this, so they suppressed silver more aggressively than gold. They used the COMEX to dump unlimited paper contracts. They used the media to ridicule silver investors as fringe lunatics. They used the regulatory apparatus to look the other way, while the manipulation continued decade after decade. The expanding gold-silver ratio was the evidence of this manipulation. A ratio of 80 or 90 or 100 made no geological sense. It made no historical sense. It made no economic sense. But it made perfect sense as a policy tool to keep silver cheap and irrelevant. But here's the thing about manipulation. It works until it does not. It works until the physical market overwhelms the paper market. It works until the supply runs out. It works until the cost of maintaining the suppression exceeds the benefit. We have reached that point. The gold-silver ratio is crashing because the manipulation is failing. The physical demand for silver has become so intense that no amount of paper selling can contain the price. The industrial applications have exploded. Solar panels, electric vehicles, electronics, medical devices, military systems. Silver is in everything, and there's not enough of it. The ratio is crashing because the market is finally recognizing what we have known all along. Silver is not just an industrial metal. It is a monetary metal. It is a strategic metal. It is the most undervalued asset on the planet. And the ratio is the scoreboard that tracks the market's awakening. Let me give you the mathematical framework for understanding where the ratio is headed. If we assume that the ratio reverts to its historical mean, we can calculate target prices for silver based on different gold prices. Let us start with a conservative scenario. Gold is currently trading around $3,000 per ounce. If the ratio compresses to 50, which is still above the long-term historical average, but within the range we saw in 2011, silver would be priced at $60 per ounce. That is a modest gain from current levels, but still represents significant upside for those who bought at lower prices. Now let us consider a more aggressive scenario. If gold rises to $4,000 per ounce, which many analysts consider likely given the current monetary environment, and the ratio compresses to 40, silver would be priced at $100 per ounce. This is the triple-digit target that silver investors have been anticipating for years. But let us go further. Let us consider what happens if the ratio compresses to its true historical mean of 15 to 20. At a gold price of $5,000 and a ratio of 15, silver would be priced at $333 per ounce. At a gold price of $10,000 and a ratio of 15, silver would be priced at $666 per ounce. These numbers sound fantastical, but they are mathematically derived from historical norms. The only thing that has prevented silver from reaching these levels is the manipulation. And the manipulation is ending. Now let me walk you through the specific forces that are driving the ratio compression. The first force is industrial demand. Silver is the most electrically conductive and thermally conductive metal on Earth. It is essential for the green energy transition. Every solar panel contains approximately 20 grams of silver. The global solar industry installed over 300 gigawatts of capacity last year. That required over 100 million ounces of silver, and solar installation is growing exponentially. By 2030, the solar industry alone could consume more silver than the entire global mining supply. Electric vehicles are another massive demand driver. Each EV contains between 25 and 50 grams of silver in its electrical systems, batteries, and charging infrastructure. The transition from internal combustion to electric is accelerating faster than anyone predicted. 5. G networks require silver. Artificial intelligence data centers require silver. Medical devices require silver. Military applications require silver. The world is becoming more electrified, more connected, more technological. And every step of that journey requires more silver. The industrial demand is inelastic. It does not respond to price in the way that investment demand does. A solar panel manufacturer cannot substitute copper for silver without sacrificing efficiency. An electronics manufacturer cannot switch to aluminum without degrading performance. They need the silver regardless of price. This inelastic demand creates a floor under the price and provides the fundamental support for the ratio compression. The second force driving the ratio compression is the supply deficit. Silver mining production has been stagnant for years. The easy deposits have been exhausted. The remaining deposits are deeper, more remote, more expensive to extract. Mining companies underinvested during the decade of low prices. They closed marginal mines. They laid off geologists. They stopped exploring for new deposits. Now demand is surging, and the supply cannot respond. It takes 10 to 15 years to bring a new silver mine from discovery to production. Even if mining companies started aggressively exploring today, the new supply would not arrive until the mid-2030s. In the meantime, the deficit grows. The Silver Institute estimates that the annual deficit is now over 200 million ounces. That means the world is consuming 200 million ounces more than it produces each year. Where does the extra metal come from? It comes from above-ground stockpiles. It comes from recycling. It comes from the COMEX vaults. It comes from the ETFs. It comes from anywhere it can be sourced. But these sources are finite. The vaults are draining. The ETF holdings are shrinking. The recycling rate cannot increase fast enough to fill the gap. The deficit is structural, and it is accelerating. A market in sustained deficit is a market where prices must rise, and a rising silver price means a falling gold-silver ratio. The third force driving the ratio compression is monetary demand. Silver is being rediscovered as money. After decades of demonetization, investors are recognizing that silver has all the properties of sound money. It is durable, it is divisible, it is portable, it is recognizable, it is scarce. And unlike fiat currency, it cannot be printed by a central bank. The monetary demand for silver is coming from multiple sources. Retail investors are stacking coins and bars at record rates. The dealer networks are struggling to keep up with demand. Premiums are elevated across the board. But the retail demand is just the tip of the iceberg. Institutional investors are beginning to allocate to silver. Pension funds, endowments, family offices, they see the same fundamentals we see. They see the deficit, they see the industrial demand, they see the inflation. And they are diversifying out of paper assets into hard assets. Perhaps most importantly, central banks in the East are accumulating precious metals at an unprecedented pace. China and Russia have been buying gold openly for years, but there is growing evidence that they are also accumulating silver, either directly or through state-owned enterprises. The BRICS nations are building the foundation for a new monetary system that includes precious metals as reserve assets. Silver will play a role in that system, and the nations that accumulate silver now will have an advantage in the world that is coming. The fourth force driving the ratio compression is the failure of the paper market manipulation. I have discussed this extensively in previous videos, so I will summarize briefly here. The COMEX has been the mechanism of price suppression for decades. The bullion banks accumulated massive short positions that they used to control the price. Every time silver rallied, they dumped paper contracts to drive it back down. But the commitment of traders' data shows that the banks are now covering their shorts. The commercial net short position has collapsed to multi-year lows. The banks are no longer willing to fight the physical market. They are stepping aside. They are letting the price rise. Without the artificial ceiling imposed by the paper shorts, silver is free to find its true value. And its true value, as measured by the gold-silver ratio, is far higher than current prices. Now, let me explain why the ratio compression tends to accelerate once it begins. This is crucial for understanding the timing and magnitude of the move that is coming. The gold-silver ratio has a peculiar characteristic. It moves slowly for long periods, and then moves violently in short bursts. It is like a coiled spring that builds tension over years and then releases in a matter of months. We saw this pattern in 2010 and 2011. The ratio drifted from about 65 down to 31 in less than a year. Silver went from $18 to nearly $50. The move was explosive. We saw the same pattern in 2020. The ratio collapsed from 123 to 65 in about 6 months. Silver went from $12 to nearly $30. The compression was violent and fast. Why does this happen? Because the ratio compression becomes a self-reinforcing feedback loop. When silver starts outperforming gold, traders notice, they start selling gold and buying silver to capture the relative value trade. This selling pressure on gold and buying pressure on silver accelerates the ratio compression. As the ratio falls faster, more traders pile into the trade. Momentum algorithms detect the trend and add to the flows. The ratio becomes its own catalyst. The compression feeds on itself until it overshoots to the downside. This is why ratio compression events tend to be so dramatic. They start slowly, build momentum, and then explode in a parabolic move that catches everyone off guard. We are in the early stages of one of these compression events right now. The ratio has broken below key technical levels. The momentum is building. The fundamentals are aligned. All of the forces I described, industrial demand, supply deficit, monetary demand, manipulation failure, are pushing in the same direction. The spring is releasing, and history suggests that the move will be far larger than most people expect. If the ratio compresses from 70 to 40 and gold rises from 3,000 to 4,000 during the same period, silver would move from approximately $43 to $100. That is a 130% gain in silver versus a 33% gain in gold. Silver would outperform gold by a factor of 4. This is what ratio compression means in practice. It means that silver leaves gold behind. It means the relative trade is overwhelmingly in silver's favor. It means that every ounce of gold you convert to silver multiplies your exposure to the coming bull market. Let me address the psychological barrier that prevents many investors from acting on the ratio signal. When silver is cheap relative to gold, when the ratio is elevated, it feels wrong to buy silver. Silver has been the underperformer for so long that investors have internalized the narrative that it will always underperform. They look at the price charts and see gold making new all-time highs, while silver languishes below its 2011 peak. They conclude that gold is the safer bet, the more reliable asset, the better store of value. This is recency bias, and it is the enemy of profitable investing. The best time to buy an asset is when it is undervalued, not when it has already made new highs. Gold at $3,000 is richly valued by historical standards. It has already had a massive run. The easy gains have been made. Silver at $43 is still below its 1980 high in nominal terms. Adjusted for inflation, silver would need to reach over $150 just to match the 1980 peak. It is cheap. It is hated. It is misunderstood. And that is exactly when you want to buy. The ratio is the objective measure that cuts through the psychological noise. The ratio does not care about your feelings. It does not care about the narratives you have absorbed from the financial media. It simply measures the relative value of silver to gold and tells you which metal is the better deal. Right now, the ratio says silver is the better deal. Not by a little, by a lot. The ratio is still elevated by historical standards, which means silver still has massive room to outperform. The compression has only just begun. If you wait for silver to make new all-time highs before you buy, you will have missed most of the move. The time to act is now, while the ratio is still elevated, while silver is still cheap, while the compression is still in its early stages. Now let me talk about what the ratio compression means for the broader economy and financial system. Because this is not just about making money on a trade. This is about understanding a fundamental shift in the monetary order. The gold-silver ratio is a barometer of confidence in the fiat currency system. When the ratio is high, it means the market is complacent about monetary stability. It means investors are content to hold paper assets. It means silver's monetary role is dormant. When the ratio is low, it means the market is concerned about monetary stability. It means investors are seeking hard assets. It means silver's monetary role is awakening. The compression of the ratio is a signal that confidence in the fiat system is eroding. It is a signal that investors are diversifying out of paper and into metal. It is a signal that the monetary reset, which has been anticipated for years, is beginning to unfold. Look at the macro environment. The United States has accumulated $36 trillion in federal debt. The interest payments on that debt now exceed the defense budget. The Federal Reserve has printed trillions of dollars since 2008, debasing the currency and inflating asset bubbles. The banking system is fragile, as evidenced by the regional bank failures last year and the ongoing stress in the repo market. The geopolitical situation is unstable. Wars in Europe and the Middle East. Rising tensions with China. De-dollarization accelerating among the BRICS nations. In this environment, hard assets are not just a speculation. They are a necessity. Gold and silver are the ultimate hedge against monetary chaos, and silver, because of the ratio, is the better risk-reward proposition of the two. Let me give you a specific scenario to illustrate the potential. Imagine that a major geopolitical event, a war, a currency crisis, a sovereign default, triggers a rush into hard assets. Gold spikes to $5,000 per ounce as central banks and institutions scramble for safety. The ratio, which historically compresses during periods of crisis, falls to 30. At a gold price of $5,000 and a ratio of 30, silver would be priced at $166 per ounce. That is nearly a 400% gain from current levels. And this scenario is not extreme. It is well within the range of historical precedent. The 1980 ratio low was around 15. The 2011 ratio low was around 31. A ratio of 30 during a monetary crisis is entirely plausible. The gains in silver would be life-changing for those who positioned in advance. The losses for those who ignored the signal would be the opportunity cost of a lifetime. Now let me discuss the practical implications of the ratio compression for your portfolio. If you currently hold gold, you should consider converting a portion of that gold into silver. This is not a recommendation to sell all of your gold. Gold remains an excellent store of value and a core holding in any precious metals portfolio, but the ratio is telling you that silver offers better relative value right now. By swapping some gold for silver, you increase your ounce count, you increase your exposure to the compression trade, you position yourself to benefit from silver's outperformance. The mechanics are simple. You sell gold at $3,000 per ounce. You buy silver at $43 per ounce. You receive approximately 70 ounces of silver for each ounce of gold. If the ratio compresses to 40 and gold rises to 4,000, your silver is now worth $100 per ounce. Your 70 ounces are worth $7,000. If you had kept the gold, your 1 ounce would be worth $4,000. You made an extra $3,000 per ounce of gold swapped. This is the power of the ratio trade. It amplifies your returns by riding the compression wave. If you do not currently hold precious metals, the ratio is telling you to start with silver rather than gold. I know the instinct is to buy gold first. Gold feels safer, more established, more respectable, but the ratio does not lie. Silver is the undervalued metal. Silver is where the asymmetric upside resides. Buy silver first, build your silver position, then add gold later if you wish, but prioritize silver while the ratio remains elevated. If you are on a limited budget, silver is more accessible. You can buy a 1 ounce silver coin for under $60, including premium. You can accumulate meaningful weight over time with modest regular purchases. dollar cost average into a position. Do not wait for the perfect price. The ratio is your guide, and the ratio says now is the time. Let me address the counter-argument that the ratio could go even higher before it compresses. This is a valid concern. The ratio is a mean reverting indicator, but mean reversion does not guarantee immediate reversion. The ratio could theoretically spike to 100 again before it falls to 40. If that happens, silver would drop relative to gold in the short term. You would be underwater on the ratio trade. This risk is real, and you should acknowledge it. However, I would make 2 points in response. First, the conditions that caused the ratio to spike to 120 in 2020 were extraordinary. It was a liquidity panic where everything sold off simultaneously. Those conditions are unlikely to repeat in the same way. The system has already been flooded with liquidity. The next crisis is more likely to be an inflationary crisis than a deflationary panic. In an inflationary crisis, hard assets rise and the ratio compresses. Second, even if the ratio temporarily rises, the long-term trajectory is down. The physical shortage is real. The industrial demand is growing. The manipulation is ending. These forces will ultimately drive the ratio lower. A temporary spike is a buying opportunity, not a reason to abandon the thesis. Now let me pull all of this together into a coherent outlook for the months and years ahead. The gold-silver ratio is crashing because the fundamental forces that drive silver demand are overwhelming the paper suppression. Industrial demand is surging. Mining supply is stagnant. Investment demand is rising. The banks are covering their shorts. All of these forces are aligned in the same direction. The ratio is responding by compressing, just as it has in every previous silver bull market. The compression has further to go. If the ratio falls from 70 to 40, silver will approximately double relative to gold. If the ratio falls to 30, silver will approximately triple relative to gold. These are not predictions based on hope or hype. They are projections based on the mathematical relationship between the ratio and the price. The ratio tells you what silver should be worth given the price of gold. The ratio says silver should be worth far more than current prices. The timing of the compression is uncertain. It could take 6 months. It could take 2 years. Ratio compression events tend to happen faster than anyone expects once they begin. The 2011 compression took about a year. The 2020 compression took about 6 months. We are currently in the early stages of what could be a multi-year compression event that takes the ratio to levels not seen since the 1960s. The catalyst could be any number of events. A banking crisis that triggers safe haven demand. A currency crisis that drives investors into hard assets. A supply disruption that reveals the true scarcity of silver. A short squeeze on the COMEX that forces the remaining shorts to cover. Any of these catalysts could accelerate the compression and send silver parabolic. What should you do with this information? First, take the ratio seriously. It is not an arcane indicator for academics. It is a practical tool that tells you how to allocate between gold and silver. Check the ratio regularly. Use it to guide your buying decisions. When the ratio is high, favor silver. When the ratio is low, favor gold. It is that simple. Second, accumulate silver while the ratio remains elevated. Every ounce you buy now is an ounce you do not have to buy at higher prices later. The compression will reward those who positioned early. Do not wait for confirmation. Do not wait for the mainstream media to tell you that silver is a buy. By the time they figure it out, the ratio will already have compressed significantly. Third, be patient, but be prepared. Ratio compression events are explosive but unpredictable. You cannot time the exact moment when silver breaks out, but you can be positioned in advance. Holding silver during a compression event is one of the most rewarding experiences in investing. You watch your metal gain value every day. You watch the ratio fall. You watch the wealth transfer unfold in your favor. Fourth, ignore the noise. There will be volatility. There will be days when silver drops and gold rises. There will be periods when it seems like the compression has stalled. Do not let short-term fluctuations shake you out of your position. The ratio is a long-term indicator. It trends over months and years, not days and weeks. Stay focused on the big picture. Let me close with a historical reflection that puts the current moment in perspective. The last time the gold-silver ratio compressed from extreme highs, in the late 1970s and early 1980s, silver went from $5 to $50. That was a tenfold increase in less than 3 years. The ratio compressed from around 40 to under 15. Those who rode that compression became wealthy. Those who dismissed it as speculation missed the opportunity of their lifetimes. We are in a similar moment today. The ratio is elevated. The fundamentals are aligned. The compression is beginning. The question is not whether silver will outperform gold. The question is by how much and how fast. The ratio is crashing because the market is waking up to the reality that silver has been suppressed, undervalued, and ignored for too long. The awakening is underway. The compression is accelerating. The wealth transfer is beginning. This has been Silver Storm Daily. The gold-silver ratio is crashing, and this is serious. It is serious because it signals the end of an era of manipulation and the beginning of an era of true price discovery. It is serious because it means silver is about to dramatically outperform gold and most other asset classes. It is serious because it offers a once-in-a-generation opportunity to build wealth by positioning in the right metal at the right time. Do not ignore the signal. Do not dismiss the ratio as irrelevant. It has predicted every major silver bull market in modern history. It is predicting another one right now. Subscribe and share this video with everyone who needs to understand what is coming. The ratio is your guide. The compression is your opportunity. The time to act is now. See you in the next report.